In this week's video, we'll review the latest charts to help us answer the question, does 2018, 2019 look like a major stock market top or a major stock market bottom? You may remember an ugly ISM manufacturing number came out on October 1st. These are all headlines dated between October 2nd and October 7th. Logic tells us if the probability of a recession was in the process of spiking in recent weeks, we would expect to see the chart of the S&P 500 start to take on somewhat of a rollover look. As we've mentioned in past videos, these charts help us monitor the net aggregate opinion of all market participants. The net aggregate opinion is bullish here, indecisive here, and rolls over in a bearish manner here. Even though the combination of fundamentals and technicals and valuations are quite a bit different at this point, relative to this point, the look of a trend rolling over is basically the same in all cases. Therefore, if we look at the exact same chart today, several weeks later, does it align with escalating recession fears? The answer is no. This is the exact same chart with the exact same moving averages dated November 20th, 2019. The look here really doesn't look anything like this, and it really doesn't look anything like this. How about recent economic data? It's a graph of building permits dating back to 1960 on the left side of your screen. The shaded areas show U.S. recessions. As you can see, typically building permits plunge prior to a recession. Thus, if we fast forward to the present day, are we seeing an imminent recession look in this data? The answer is no. The data printed a higher high this week. It's possible you may be thinking, well, that chart looks good, the trends are strong, but what about something like the 1987 case? Aren't we still vulnerable to a major plunge in the present day? As always, to help us answer that question, no opinions, let's look at the hard data. This is a chart showing the percentage of NYSE stocks above their 200-day exponential moving average. It is a measure of market breadth. You can probably guess this is Black Monday here, and this is an extremely low reading, below 10%. And the look of this chart off of the low basically tells us that institutions started to buy in this region here, pushing this breadth indicator from an extremely rare and oversold level all the way back up to 62.8. How does all of this compare to what we've seen in 2018 and 2019? In late 2018, we also have an extremely rare oversold reading on the same breadth indicator. And just like the look of the chart after the bottom in 1987, this is basically your evidence of institutions stepping in and buying. This is a form of a breadth thrust. And very, very similar to the 1987 case, the indicator moves from below the blue line and climbs its way back all the way to 62.8. This just happened on November 5th, 2019. Thus, November 5th, 2019 is very similar to October 10th, 1988. Thus, from an anecdotal perspective, it might be logical to ask, how did the stock market perform walking forward from October 10th, 1988? If you're old enough, you may remember sentiment in this area here. America's best days are behind us. And very, very similar to the present day. After the 1987 crash, and off of that low, skepticism is extremely high. We have a lot to cover, so you can pause your video player if you like, but there are other similarities between this period and 2018, 2019. In the wake of the 1987 crash, was skepticism rewarded? The answer is no. Stocks performed extremely well after October 10th, 1988, which is similar to November 5th, 2019. Anecdotal cases are nice for illustrating concepts, but we really need to know what happened in all cases. Therefore, it's prudent to ask, how many times has something like this occurred since 1986, and what happened next in the stock market? Why 1986? Because we only have data going back to 1986. We already said 1987 and the 2018 low are similar. There were 5 previous cases where we went to an oversold level at or below the blue line and then made it back to the green line. And keeping in mind, this just happened on November 5th, 2019. What happened next in the stock market in all of these cases? The answer is really, really good things. Every single case, the stock market was higher 1 year, 2 years, 3 years, 4 years, and 5 years later. The median gain looking out 5 years, over 70%. What about small sample sizes? You can pause your video player. There's only 5 previous cases with this indicator. 2018 low is similar to the 2009 low, and you can find the details in this short takes post here. It's also interesting to note, cash levels in the present day are very, very similar to cash levels at the low in 2009, and obviously there are some differences between comparing 2009 to the present day. But when we're talking about cash levels in the present day that are near decade highs, that means we have relatively high cash levels. Seems a bit odd that we would have cash levels that high in the present day given the facts that we have in hand. And for clients, the next segment may help you understand our actions after this low here relative to our allocation to growth assets relative to defensive assets, and it may help you better understand our present day allocation. Since we like to address these questions with facts, we've already established the 2018 low is similar to 2011, 2009, 2002, 1990, and 1987. It's interesting to note the 1987 low has never been revisited. The 1990 low, which is similar to the Grinch plunge low, has never been revisited. From a cost basis perspective, adding to growth in here was a fantastic idea. From a cost basis perspective, even if it took you a full year to allocate back to growth, it was a fantastic idea. How about the other cases? Every single case was a major low, and in every single case, it was a really good idea to allocate back to growth in the wake of the low. Good things happen for a really long period of time. Similar to this low, this low. 2009 and 2011 lows have never been revisited. So if you can establish your cost basis in here or here, it's a fantastic idea. So here's our original indicator with the S&P 500 on the bottom. When you see something like this, it's easy to understand what our working hypothesis has been during calendar year 2019, especially after the 10-day breath thrust early in January. Our working hypothesis has been that this is a major low, a low that potentially will never be revisited. Never is a strong word. This low has never been revisited. This low has never been revisited. The same can be said for this low and this low. And in this case, it took 6 years to revisit the low, with several years of satisfying gains after the low. So relative to our working hypothesis from this January 21st short takes post, if history is any guide, it would not be surprising to see the current stock rally continue, the data to improve, and for us to incrementally add to the growth side of the portfolio at a much faster rate. In the remainder of the video, we will continue to test the working hypothesis to see if we can poke holes in that hypothesis. If you're into pattern recognition, you may have noticed something on the 2018-2019 chart. something that also would align with the hypothesis that this is a major low that potentially will never be revisited in our lifetimes. Chart patterns speak to repeating patterns of human behavior and investor psychology. Historically, from a look like this, so this period right here is similar to these dates here. This green table here, with the average gain being 75% 5 years out, it aligns nicely with the major low, which is our working hypothesis. And keep in mind, that hypothesis was developed in January of this year. Very, very difficult to say that the look of this chart between January and the present day does not align with that hypothesis. Doubling back to the previous cases, interesting to note the low in 2018 similar to the low in 1987. And a completely separate analysis also told us that the present day was similar to the 1984 to 1987 window from a demographic perspective. And remember this case here, where this low was actually revisited? This period here looks quite a bit different than this period over here and this period over here. How can that be? Well, look at the look of the chart pattern here, here, and here, and the look of the chart pattern here, here, and here. If you were taking a technical analysis test, and based on the weight of the evidence, you were asked which one of these lows looks least like the others, you would pick 2002. And if it seems almost comical to say that this low may never be revisited in our lifetimes, or at least for several years, this chart and a previous study based on this chart, based on facts that we had in hand, facts that we can measure, 100% of the cases higher 5 years later. The median gain was 93%. Many of the historical studies tell us it's possible, looking 5 years out, that the S&P 500 could gain between 50 and 90%. If that turns out to be the case, then it's not so laughable or comical to say that this low may never be revisited in our lifetime. Is there anything else that we have in hand recent signals that would align with the theory that this low here is a major low? Yes, this is a November 15th article. You can find it on our blog, Short Takes. To find our blog, you can Google Short Takes and our last name, Shavako. It covers an extremely rare recycled DeMark count. We just saw this. Notice the other cases align very, very nicely with the thesis that we're in a secular uptrend. This is a cyclical low within the context of a secular trend. How did the market perform in the previous cases? 5 years later, 100% of the cases the market was higher. The median gain was 67%, the average gain over 100%. Also saying that it's not really laughable or comical to say this is potentially a major low. We're not making a forecast here. We're simply continuing to work off of the hypothesis that was formed in January. If we walk forward and the data starts to contradict that hypothesis, then we'll have to adjust our hypothesis and our thesis. And if you're relatively new to these videos, you might be saying, toss all this out the window because of valuations. If you do your homework, that's not the case. From this point here in 1982, you can't predict the future. You have no idea what the Shiller PE will look like in the future. You can only look backwards. When you look backwards from 1982 all the way to 1881, the median Shiller PE was 14. Nobody in their right mind thought the Shiller PE was going to 44. Just as no one has any idea what the Shiller PE will look like over the next 20 years. Are valuations a valid concern? Yes. Are they a showstopper? No. Are valuations a good timing tool? No, we've covered this in the past. Could have been wrong for 13 years saying valuations are too high. Another common what about this question is that sentiment has been improving. You can find this chart here in our Twitter feed. Here's the Twitter handle. You can find the account by Googling the Twitter handle here or Googling Shivako and Twitter. You don't have to be on Twitter or particularly like Twitter to review the information on the feed. Common sense tells us you can't have a multiple year rally with sentiment in the trash can. Sentiment has to turn. Why? Because improving sentiment is what causes people to invest cash and reallocate their portfolios. Look at this advance here in the S&P 500. Look at sentiment in here. Does bullish sentiment look like a bearish indicator? Does bullish sentiment that blows away sentiment in the present day, look like a bearish indicator? Sentiment is like any other tool. We can't use it the same way in every market situation. Within the context of a range, the way we use sentiment is different relative to the way we use sentiment in the context of a strong trend. And it really doesn't matter about our personal opinions. You can look at this chart. It's not unusual for sentiment to rise from low levels to the blue line. Low levels to the blue line and stocks to do well. Low levels to the blue line and stocks to do well. Low levels to the blue line right here and stocks do very well. Looking at the chart is helpful, but it's more helpful to do a study. And we did just that. Sentiment here recently went from the orange line to the blue line. How many times has it happened in this bull market and what happened next? The bull market piece is important because the way that we use sentiment in a bull market is different than the way we would use sentiment in a bear market. Why are we assuming we're in a bull market? Because we are in a bull market. The trend strength model is a submodel, a CCM market model. It's in the high 90s right now. That's not what a bear market looks like. In the future, when we have evidence in hand that looks like the early stages of a bear market or looks like a bear market, then it makes sense to perform studies on sentiment in bear markets. So what can we learn from this data here, something that just happened in November? 5 years later, 100% of the cases higher, median gain was almost 80%, making it much, much harder to die laughing when we say it's possible this low will never be revisited in our lifetime. That's hard to believe, but that's the case here. It's the case here. It's the case here. And it's the case here. Simply telling us to keep an open mind about that possibility. This breadth study was based on NYSE stocks above their 200-day exponential moving average. This is another breadth indicator. The concepts are similar. This is an extremely rare oversold reading. We recently made it back to this level here. Before we look at all the cases, let's look at an anecdotal case. Present day, you go from the blue line back to the green line. 2011, we go from the blue line back to the green line. What happened next in this case? The answer is really good things happen for a long period of time. But we really need to know what happened in all of the cases. So now, how many times since 1982 and what happened next in the stock market? We're looking for cases that are similar to this move here, something that just happened in calendar year 2019. There were 10 previous cases going back to 1982. In all 10 cases, the S&P 500 was higher from the date of reaching the green line. The average gain, 78%. The median gain, 75%. Simply telling us to keep an open mind about the possibility that this is a major low. All of the statements that we're making are probabilistic statements based on the facts that we have in hand today. The whole purpose of continually performing studies about things that just happened is to test that hypothesis. And if you're into pattern recognition, you may have noticed something on this chart here. If we're looking at shorter term breadth charts, you might say it's a little concerning here. If we look backwards, breadth looks a lot stronger in these areas here. Now remember, we've said there's a lot of similarities between the early to mid 1980s and the present day. Look at breadth in here. It's also relatively subdued. And it makes sense. This is after the 1987 crash. There's a ton of skepticism in here. This is after last year's plunge. There's a ton of skepticism in here. And notice, during this entire move from 1986 to 1997, NYSE new highs is relatively subdued relative to some of these other periods. And yet, really good things happen in the S&P 500 and NASDAQ, telling us that this look here is not necessarily a showstopper or something that should make us toss and turn at night. The look here is similar to the look here. 2019 demographically is 31 years from the midpoint of the millennials' birth range here. And this period here, 1986, 31 years from the midpoint of the baby boomers' birth range. It's another breadth indicator. Way to the evidence. You can pause your video player. Have data in this case going back to the early 1980s. Very, very rare move similar to this move here. 4 years later, 100% of the cases were higher. The median gain 55%. Let's shift gears to some of the fundamental data. What about credit spreads? It's a broad gauge of credit spreads that we cover regularly in these videos. This is the recession here. You can see credit spreads are widening. This is increasing fear prior to the recession and bear market. And during the bullish phase, it's really just the opposite. Spreads are narrowing. This is a concerning, increasing concern look. This is an increasing confidence look. As we've noted many times on these videos, we're really not using credit spreads to predict anything. They can move rapidly. We use them to monitor the present day net aggregate opinion of all market participants. See the spike here before the recession. This is a big spike here. It starts before we go into 2008. This is still in the relatively early stages of the horrible financial crisis bear market. So if we break this range into quadrants, highest confidence, second highest, high fear in here. If we fast forward to the present day, what quadrant are we in? We are in the most favorable quadrant, similar to the look prior to the peak, similar to the look in here when the market was advancing. And we have a series of lower highs and lower lows, which is quite a bit different from this look here and this look here. This is a point-to-point slope, point-to-point slope, point-to-point slope. This number has moved up a little bit, but 4.18 is still lower than the reading that we had on June 5th, June 6th, and the present day reading of 4.18 is still quite a bit lower than these concerning levels here before the market took another leg down. And even though this number has creeped up a little bit, we're still in the lowest quadrant and still quite a bit lower than these levels here. This is a different data set using riskier bonds. Starting to see a little bit of a move here. In some respects, that's good news. Why? It's good to have hard data in hand that helps us keep that flexible, unbiased, and open mind. This is telling us to do what we're already doing, which is to keep a close eye on this. This is not particularly alarming at this point. This is a pay attention look here. How about the Chicago Fed National Financial Conditions Index? This is the average and median read prior to significant additional losses in the S&P 500 historically. Does the present day really look anything like this? The answer was no. On September 13th, we were at negative 0.72. Lower is more favorable. If we fast forward to the most recent data, are we better, worse, or about the same? The answer is better and lower. The latest reading is lower than 0.72 at negative 0.77, which speaks to higher confidence and higher trust in the broad financial system. No way we can cover all the studies in this week's video. We will try to get some of them up on short takes, up on Twitter, and or on LinkedIn. These are really great visuals of the net aggregate opinion of all market participants. This is an uptrend. This is a consolidation and a breakout. We've already established that November 20th really doesn't look anything like this or anything like this. What can we learn if we compare the present day to some other periods in history? I think it's fair to say that the present day looks a lot more like the bullish 1983 to 1985 window, and the present day looks a lot more like a market that needs to consolidate its gains and then breaks out window in 1993 to 1995. This is a full-bore bullish look. This is morphing into full-bore bearish. This is morphing into full-bore bearish. So if November 20th, 2019 has something in common with August 1st, 1985 and March 15th, 1995, it might be helpful to know how the market did from this point walking forward and this point walking forward. So let's move these dates down here and then walk forward in the S&P 500, which would be similar to walking forward from this point here in our hypothetical illustration. From the similar look in the historical cases, the S&P 500 did extremely well. From the similar look in the historical cases, the S&P 500 did extremely well. Now remember, these are facts. Do these three charts and do these three charts and the returns shown on the screen here align with or contradict the working hypothesis that this could be a major low? Do they align with or contradict this chart pattern here? Do they align with or contradict this table here? Do they align with or contradict this theory here? Do they align with or contradict the thesis that this is a cyclical low within a secular trend, a cyclical low within a secular trend? Do the look of those charts and the returns align with or contradict the DeMark signals, a signal that we just saw? Do they align with or contradict the theory that we should keep an open mind about what valuations may or may not look like 10 to 20 years down the road? Do they align with or contradict the results of this sentiment study about something that just happened in November? Do they align with or contradict the numbers in this table based on this study and something that recently happened in calendar year 2019? We've already established that the present day chart pattern looks like this period and this period. Fractals tell us that this look here can occur on different time frames. The look here, somewhat similar to the look here. This is a bullish period. This is a great time to buy. And the look in here, somewhat similar to the look in here. This is a bullish period and a great time to buy. This point here, December 1st, 2016, is similar to this look here. This look here, August 1st, 2012, is similar to November 20th, 2019. How did the S&P 500 do if we walk forward from this date and this date? We've moved the dates down here, and the answer is very well. All of this simply speaks to probabilities, just as this look speaks to probabilities. Let's use these very, very simple charts to help illustrate some basic concepts walking forward. This is our unfavorable look here. This is a deteriorating look here, and this is an unfavorable look here. This is our transition to a full bore bullish upper right. This is our transition to a full bore bullish upper right. And this is our transition to a full bore bullish upper right. What charts are we looking at, and what can we learn from these charts? This is the turn at the major low. And this is also a major low. This is the end of the dot-com bear market and the transition to a new bull market. This is the end of the financial crisis bear market and a transition to a new bull market. It's very, very difficult to say that the present day looks more like this or this relative to this and this. And the look of these charts relative to the look of the present day takes us all the way back to our opening study in this week's video. Here's the present day, dot-com bust low, financial crisis low. Here's the present day, here's the dot-com bust low, and here's the financial crisis low. So we have to ask ourselves, based on the weight of the evidence, does the present day look more like a major top or a major bottom? It may also be worth a visit to the new website to see the FAQs. We've got new and expanded FAQs covering traditional investing, low-cost passive investing, and the online/robo strategies that are currently in vogue. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.